So it's actually a pleasure to introduce something different this morning. Within Council for years, we were discussing different ways that our AAVSO members can actually contribute to the AAVSO in terms of donations. And one of the items that we're discussing is how we're going to provide you with the slate of choices that are there so that you can give in a way that is comfortable to you. We were discussing of having this kind of presentation, this kind of discussion, but we didn't know who would do it. So at some point it was in the back burner, and we decided not to make it the back burner, not to leave it in the back burner anymore. We were also very fortunate to be working with Tom Alessi and Greg. Tom Alessi and Greg Richardson. Thank you, Greg. I'm already brain dead. Over the last couple of years, they really helped us revamp our retirement plan. They have been very close financial advisors at headquarters, and they actually agreed to come here and give you a presentation about different strategies and ideas to donate to the AAVSO. So with that, I would like to introduce each one of them. Tom Alessi has more than 20 years of experience in financial services. His specialty and expertise are in investments and risk management. Tom's practice focuses primarily on working with nonprofit organizations, trying to help them and their employees have a better understanding of the overall financial well-being. Tom is an avid sports fan. Is that Red Sox? Oh dear. An average but enthusiastic golfer, and has a soft spot for really bad movies. Is that Legally Blonde? Movies. Tom says that he gets his love of presenting and doing workshops from his wife, who is a teacher. He has 2 daughters, both juniors, one in college and one in high school, who are always keeping their dad on his toes. And for those of you who have kids, teenage girls, you know what having a teenager at home looks like. Actually, the first person that I met from this team was Greg Richardson, and we met by chance and we kept discussing. So he's been one of my closest collaborators, and it's a pleasure to have him here. He has been in financial services for the past 15 years, working in a practice that primarily focuses on holistic financial planning and asset protection strategies. He works with his clients to show them how to be more efficient with their planning so they can achieve the financial goals. Craig is an avid hunter and a mild but engaged car buff. He promised he's going to show me how to do archery at some point. At some point, we'll do it. As with Tom, Craig's wife is also a teacher, and it's where Craig says he gets his sense of inspiration for trying to help and educate his clients. Craig also has 2 teenage daughters who keep their dad busy and up on the latest trends, whether he wants to be involved with them or not. Teenagers tend to volunteer you, right? So it's a great pleasure to have both Tom and Craig here. We will start this session with a short presentation from them and then open it to questions from you. In your packet, you also have information, an outline more or less on how to donate to the AAVSO. So you don't have to keep notes if you don't want to. And of course, both Craig and Tom are available for questions. They're going to be around all day. So with that, let's welcome them to our meeting. And looking forward to the presentation.
Thank you, Stella, for that tremendous and insightful introduction. I will say this, the part about the bad movies is the expressed opinion of my wife. And as you can imagine, in situations where we have a differing of opinion, I always lose. So I will say this, it really comes down to our expressing the cinematic quality of Westerns. Really anything involving Clint Eastwood will just, my wife will not deal with. So we are very excited to be here today. We came a long way. Our offices are just outside of Boston. We're not too far from AAVSO HQ. So we're really glad to be able to be here with you. We've got a lot to go through, so I'm going to jump right into it. But yes, the idea here is different ways and thoughts to gift to the AAVSO. Now, usually what I do in a situation like this is I usually ask all the guys to stand up and stretch your legs, and we do a little thing and a routine with them. But you all just did that, so I'm not going to have you go through it. Instead, I'm going to bring Craig up, and he has no idea, because this is improv at its finest. So come on up. And what I want you to do, right, is just take a real relaxed stance and get your arms nice and relaxed, right? Just like that. Right, now put your hands down. And now do it with the other way around. recross your arms. See, there you go. See that? So the idea there is just we form habits. Usually I make the guys stand up, take their belts off, and try to put them on the other way. We don't have enough time to go through that because it's very funny to watch sometimes to make it go through. But really the idea is to get you to think of different ways, maybe some of the already doing or already thinking about doing, but different ways to think about gifting to the AAVSO. I have to give you this disclosures, you know, this is legal and compliance in my world with all of this, but really what it comes down to is we're giving you information that involves some tax strategies. Some of it is federal law, some of it is state law. All of these things are changing on an ongoing basis. There's going to be rules 2019 that's going to change, 2025, some of the estate laws are going to change. So just realize that when we're talking to you about most of what we're talking about, it's about today, because that's really all we can focus on. We do know there will be changes coming. We didn't make this stuff up. It's what the law is now, or what the rules are now, and what you can do. So charities rely on donations, right? So there's competition coming from everybody, right? You've got your needs are everywhere. I think one of the gentleman with the 55-year pin had mentioned about he's getting, and that's amazing. I got to tell you that you've been doing this as long as I've been alive. That's amazing to me. But he had mentioned that he's getting all of these requests and donations in from all over the place and all different organizations. And so that's part of it. There's a lot of competition out there. But really, you know, the bottom one, the tax law changes, and we'll touch on that a little bit. But for a lot of charities, they rely on the fact that you used to be able to do itemized deductions. And because of the new tax law changes, those itemized deduction limits have gone up. And what you can claim on your, as far as the house and home has gone down and been capped. So now the question comes for charities is that some people are looking at it going, well, I can't itemize anymore, so is it really worth it to me to do this donation that I've been doing for so many years when I was getting that deduction? So it's another thing to be thinking about as we go forward with this. God, this thing's killing me. Where did it see? Owen ran away on me, right? So why do people give, right? This just goes through some of it, right? It's a belief in the mission, further worthwhile cause, improve the quality of life. But really, when we go down in all of this, it really comes to the tax benefits. Avoidance of capital gains, estate tax savings. Like I said, that's going up. It went up again this year, 2025. That might be repealed, but we can't, we can't project for that. Gift tax avoidance, because there's so much limit that you have with that. But one of the things we will talk about as we go through the presentation, oh look, I forget, I keep pointing with that and I forget there's a razor pointer on that. With estate tax, that for some of you, and like we said, we're from Boston, so everybody knows Massachusetts, they're taxing us left, right, and sideways. So we not only have a federal estate tax, we've got a state estate tax. And so there's limit differences there in what it means. And so while you may not fall under that federal estate tax, you could fall under the mass estate tax or your individual state. Yes, sir. Okay. I did not put him in the audience. When we come to that in a second, absolutely. That's why we're here. And we're going to go through. I forgot about that. Oh, again, Owen abandoned.
I was saying a number of us are 70 and a half or older, and so that brings up the mandatory or required withdrawal from your IRA. So you're going to talk about that and the tax implications.
And again, the answer is yes, it's part of the presentation. We're going to go right into that in a second here. So this comes right off the AAVSO website. If you've ever looked at the page, this talks about all the different ideas, different strategies that are out there. We have a limited amount of time, and I'm holding you up between getting out into the rotunda and doing the group photo and then having lunch. So we've got a short window of time to do this. I don't have the ability to go into cruts and clats and crummy provisions with you today, okay? We've got two topics. Oh, jumped it on me again. We're going to talk about two of these, gifts of life insurance, and then for the gentleman who just asked the question, qualified charitable distributions or what the impact is on IRAs and making those contributions. And with that, I'm going to turn the presentation over to Craig to do the life insurance part.
Can you hear me? Good. So one way to actually do charitable giving or plan giving is through life insurance. One of the benefits of using life insurance is the fact that you can name a beneficiary directly and you don't have to worry about wills, probate, and all those types of issues. The other reason it's a really good tool is because it allows you to use a smaller payment in order to make a much larger contribution. So with that, the donor transfers ownership. This is one way of doing it. If you have an existing life insurance policy, the donor can transfer ownership to a life insurance policy on his or her life to the charity, which changes the beneficiary designation to himself. So the donor may also pay the premiums on the policy either by paying them directly to the insurance company or by making annual cash transfers to the charity, which then pays the premium. The more favorable deduction limit is the latter. So basically what you're doing is you can donate the policy and then you continue to making the payments. The way you would do that to get the most favorable tax advantage would be to actually donate the premium payment to the charity, and then the charity would make that payment from there. That way you would get the tax deduction in that year. At the insured's death, the life insurance company pays the policy proceeds to the charity as a beneficiary, so that automatically will supersede any of the will, trust, all that kind of stuff because you have a direct beneficiary. Gifts of life insurance. Donor can make a substantial gift for a modest annual outlay, which we were just talking about. Premium payments may be limited in number and may be flexible with some policies. So with this, you don't necessarily have to pay the premium your whole life. You can decide if you're going to, especially if you're setting up a new policy, do I want this to be a 5-year pay, 10-year pay? How much money do I actually want to donate, and what would the benefit? What's the best way to set that up to give the charity the best benefit? Premium waiver may be added to complete the gift in the event of a disability. With certain life insurance policies, they have what's called a waiver of premium. So if you became disabled for some reason, and they would actually pick up the premium payments for the remainder of the term. So you could actually, even if you became disabled, still complete that gift to the charity. Charity is beneficiary, either primary or contingent. Donor retains ownership and access to the cash values. No income tax charitable deductions is allowed, however. So in this particular case, you could actually, if you have an existing life insurance policy that's your own, what you can actually do is just name a portion of the proceeds to your charity. So let's say you had a $500,000 death benefit on your policy. You said, well, I want to leave 10 or 20 or 30% to the charity. You just name them as either a primary beneficiary, means they're going to get it if you pass away, or you can also name them as a contingent beneficiary in the policy. Let's say the policy was meant for your wife, but your wife predeceased. Now the charity could actually become the primary beneficiary after that. An unlimited charitable estate tax deduction, which means that any of the face amount that actually gets donated to the charity is going to be deducted from your estate. Okay. So more advantages to the charity. More donors can make major gifts. And the advantage to the donor is lower cost to your estate and heirs. Charity controls the program, amplifies the leverage of the gift. So in other words, some people say, well, yes, I want to, and Tom will get into this a little bit later, but I do have a required minimum distribution because I'm 70 and a half, but I really don't need the income from it because I have other sources, but it's adding to my taxable income. Well, you may be able to say, well, I'll donate this to my favorite charity. Well, way to leverage that, once again, would be through life insurance. Now I can turn that $4,000 or $5,000 or $6,000 a year gift into a possible $200,000 or $300,000 or $400,000 gift later on. A growing asset, cash provided during lifetime, experience rewards of gifting during your lifetime. So when you're doing that, you're actually seeing some of the benefit going to the charity as you're still alive, as opposed to waiting until you passed away. Perpetuates annual gift to donor, flexible outlay. Gift is free of probate tax and debts of the donor. So you don't have to worry if you've had some issues with your estate because you're doing this directly to the beneficiary. So it supersedes all of that. And it generates gifts in addition to regular cash contributions. Life insurance values and your gifts are guaranteed. There's the advantage to the donor. Self-completing the event of death or disability. Gifts may be made with no publicity and cannot be contested. So if you did this, say if you did just had a will and you decided to do this as a bequest to the charity, if it goes through probate, all of that information is actually listed as public information. If you list it directly as a beneficiary in a life insurance policy, that never becomes public information. It's a private donation. Okay. So this is just a little bit of a sample of how you can leverage that. Let's say your annual gift was going to be $12,000 a year. Your tax saving in the 30% tax bracket would be about $3,700. That's what you would deduct. All right. So your after-tax contribution is actually only $8,600. As the years go on, that cash value builds up in the policy. So you can see if you were donating for a period of 20 years, you'd have a cash value in the policy of $123,000. And this is, you could own and retain ownership of the policy, or the organization could. The organization now would have access to cash inside the policy before you actually passed away. All right. And then, like I said, if you did pass away, the death benefit would be $250,000. Your total donations, because you limited the amount of premiums that you paid in for 5 years, was only $43,000. So you can see how you could leverage that $43,000 donation and turn it into a $250,000 tax-free donation to the charity. Okay. And what it's showing in the last column is perpetual income, which is really important to organizations to have operating expenses paid. This is showing if you take that $250,000 and got a 6% return, you'd actually create perpetual income, make you basically giving an immortal donation to the charity. It also shows, well, if I do that, am I going to hurt my heirs, right? So let's say I decided I wanted to bequest $250,000 to the charity. Well, then it's going to cost my heirs $150,000, even though I'm going to get the tax deduction of 40%. But if I do it through life insurance, I'm giving just as much money, but the cost of my heirs is only $25,000. So once again, you're not taking away from your heirs by doing this. It actually, if you are charitably inclined, it's a way to get a lot more leverage for your dollars. So in summary, gift of new policy, these are just shows this, and this should be in your packets as well, of what the benefits are to each way of doing this. Whether it's a gift of a new policy or a gift of an existing policy, who should be the owner and who should be the beneficiary, and that's going to be based on every single person's individual situation. Okay. So the other thing to think about too is a big thing that comes up today in our planning process with a lot of our clients is long-term care, right? We found it, I think Tom could give us a quote on this too, that most people have made a decision to either buy it or not buy it by age 60 or 61 years old. Right?
Yeah, so the statistic shows that if somebody was going to purchase a long-term care policy, the average age of purchase is 60. For somebody who's not going to purchase, that average age is 61. So to tell you, there's a delineation, a clear-cut line of who is or who doesn't have long-term care.
So in that event, like I said, standard long-term care policies, off the shelf, you pay the premium, and if you use it, great. If you don't, you lose it. Those have kind of going the way of the dodo. You don't see so many companies carrying those anymore. The reason is because when the company started out doing these about 15 years ago, they priced them wrong. And that's why they started getting out of the business on it. People they thought weren't going to hold these policies, but they wound up holding them. Even across all of the industry rate changes, they've held them. So what they've done in response to that, because the long-term care need has not gone away, is created hybrid products, which actually incorporate either an annuity or life insurance in with your long-term care benefit. So what does this mean for you who are charitably inclined? Well, what you can do is actually kill two birds with one stone. The issue is you can actually have a life insurance policy that has long-term care benefits built into it. If you use a portion of those benefits, but not all of them, the remainder of the death benefit actually goes to your beneficiaries. And those beneficiaries can be a charity or your heirs. So it allows you now to cover a need that you may have, but still be able to donate to a charity with the remainder of that policy. The only thing in that particular case is you're not going to give up the ownership of the policy because the charity can't give you back the proceeds for your own long-term care. The other way you can do this is through a deferred annuity. Annuities we have today are hybrid products that can actually incorporate long-term care as well, and it's the same situation as life insurance. So if for some reason you didn't qualify necessarily for medical reasons, which happens a lot, then you could do an index to care annuity or something along those lines. And once again, if you don't use all of the benefit, that benefit goes to your charity or your heirs. And that brings us to Tom's piece with the IRAs.
Thank you, Craig. So this is, now we're talking to the IRAs, and that's the question that got asked earlier. Before we go into the required minimum distribution part, however, let's go to the worst part scenario, which is you passed, right? So we're killing you off here. So you can just make a simple request from your distribution, the beneficiary to your IRA. You can just name the AAVSO as a portion of the beneficiary. In some situations, if there isn't other heirs other than a spouse, say, or maybe you have an only child, spouse has already passed, you can name the AAVSO as your contingent beneficiary, which just says if the primary beneficiary has passed away, now the charity, or in this case the AAVSO, will take over and receive the benefits once you do pass. Okay, that's all this is talking about. You don't have to go through any attorneys or lawyers or trusts in terms of making that request. That can be simply done with a beneficiary change form for either an IRA or through a qualified plan. Okay? Hopefully that went the right way. So now this is where we get to the question on the 70.5 qualified charitable distribution. So one of the things that did happen with the new tax law change this year, besides that raising of the itemized deduction limit, is they actually made QCDs, and I feel like this, I have the forgive me, the samba of the acronym line here. I've got IRA, I've got RMD, I've got QCD, I've got CRT, cha-cha-cha, right? This whole line going on with that. So QCDs, a qualified charitable distribution, they actually enacted it into law. So it became law. It was originally started in 2015. They passed it, then they reversed it. Then they turned around and said, no, this makes sense, because this is a way that we can help individuals who want to gift to charity continue to do that. And what it says is, for that RMD question, if you are now have reached 70.5, you can donate your RMD to charity directly. Has to come from the trustee, has to come from the custodian of the account, and it will bypass taxable income to you. So in Craig's example, if you had a $5,000 RMD that you had to take this year, you could direct the custodian of your IRA to send that $5,000 directly to AAVSO, and you've bypassed taxes, because it would go to AAVSO and they're not getting taxed, right? So you now have done that, where that's taking away, and you do not claim that as taxable income. You don't have to itemize it. It's just automatic. But only for those who have reached age 70.5 does that work. Because that's the question, because that triggers right to the required minimum distribution, or RMDs. 70.5, your favorite uncle turns around to you and says, I want some money now. You got to give it to me. And every year he's going to keep coming back and saying, I want my money now, right? That's what happens. So 6 donors, I don't have time to go into all 6. I'm going to take the bottom 3 when we talk about this. So the Social Security donor. So for those who have reached or decided to claim Social Security benefits, it was a nice little wake up with that you might have realized that your Social Security benefit is taxable anywhere from 50 to 85%, depending on how much other income you are drawing. And it's a wonderful little game that Social Security plays with you on that, because Social Security looks at income one way when they stack income. Medicare, that other wonderful institution, looks at a different way of stacking it. And of course, then we have the IRS, who's looking at it in a completely different way as far as that's concerned. So when you're taking a distribution from your IRA, your 401k, whatever qualified account you may have, it's counting as taxable income. That taxable income then gets looked at by both Social Security and Medicare, and you may end up getting taxed higher or more on those benefits without realizing it. Again, anywhere from 50% to 85% of that benefit. The standard deduction donor, we talked a little bit about this, where the standard deduction has now gone up. So whereas you might have been itemizing before, for 2018, you may no longer be itemizing. Whereas you may have been saying, I've been sending money to AAVSO, I've been using that as an itemized deduction, and now I can't do that anymore. And the last one, the state tax donor, this is what I talked about because I get to say I'm representative of the wonderful state of Massachusetts. And that not only do we have a state tax there, but we also have a state tax. So an estate state tax and the state tax in Massachusetts. And so there might be state taxes that you were paying that you did not realize you could bypass as well if you take advantage of the qualified charitable distribution, the QCD. What does that look like? So we're out here in Arizona. I said we're from Massachusetts, so we picked somewhere right in the middle of the country, right? Indiana. I don't know any of you, if you're from Indiana, okay, this works for you. But we figured middle of the country, and the state tax in Indiana, at least that we had, was 3.5%, which, again, right in the middle of those states with zero and those states that are up to close to almost 7% for a state tax. So this just looks at it and says, I've got a couple, got a Social Security income, they've got some IRA distributions that they take, and they want to do a $1,000 QCD. What does it look like as far as those numbers are concerned? And you can just see A is without doing a qualified charitable distribution. They may be taking the RMD and then sending the money to the charity in that situation, or they might not be doing it at all. Or B, I'm making that charitable donation, and how much do I end up saving just on that $1,000? Again, this is the state of Indiana. Your state might be different, but how this works as far as federal and then Indiana tax. I gave you in your packet, there are two handouts, one from me and one from Craig. I told you at the beginning of the presentation, I wasn't going to go into CRUTs and CLATs and all those other things, but this does talk about what a CRT or charitable remainder trust actually does. It allows you to take an asset, gift it to the charity, make it an income stream to you, and then whatever's left at the end of it, the remainder, goes to the charity. So there's a whole breakdown inside your kit that shows you how this works, what it means, what it could mean to you, as far as creating additional income stream for you if you're in retirement or getting near retirement, that you may have an asset that's not doing that for you right now. This just does the same thing. It just talks about supplementing it. And you can do it the other way around. I don't want to get too deep into that. But a lead trust just says, instead of paying me the income, I'm going to have the income go to the AAVSO. And then whatever's left at the end goes to my beneficiaries or heirs or back to me. So there are ways to do the road either way. So this is our information. Our information is also included in your kit with the handout. I will tell you one thing with this one. We weren't able to include it in the presentation because we didn't get approval for it beforehand. Craig talked to you about life insurance and the idea of getting a policy and naming AAVSO as the owner and beneficiary with you as the insured on it. What we were able to find out, because we finally got compliance and legal in my world is a very, very tough road to hoe in terms of that and going through everything. But what we are able to do or to say is to any member, whether you're here, whether you're on the call, or that we end up reaching out to us and working with us as far as the life insurance policy is concerned, we're able to say that we can donate back a portion of the premiums that go to fund that immediately to AAVSO. So if you think about it, you'd be creating a legacy, whatever that gift ends up being, but you would also then be sending money to AAVSO today to help with the ongoing work that they do. So it's just something that we're able to do. We just We couldn't get it in there because, like I said, it was wrangling compliance and legal to allow us to say that in the great grand scheme of everything. But so if you do reach out to us, we're happy to answer questions and work with you, but we will have the ability to give back a portion of the premiums in a life insurance case to the AAVSO.
And just one more thing that Stella had mentioned, we have been working together for a few years now, and I've gotten to know a little bit more about the AAVSO and the way that you guys work. And I know, once again, the AAVSO exists because of fantastic members like yourselves. And not only that, but a lot of you fantastic members have done charitable donations in the past that have actually supporting the AAVSO. So this is a model that the AAVSO has grown on, and it can grow much more substantially in the future if you are so charitably inclined. Thank you.
And that is going to end our presentation, right? The only thing you can take with you when you're gone is what you leave behind. So again, that sort of thought of, is there a legacy or a vision that I would like to establish as far as AAVSO is concerned? As Stella had said, Craig and I are here all day. We're going to be here through dinner tonight. So if you have individual questions, want to just have a conversation or a chat or something that we brought up or that you've been thinking about, we're here to answer your questions. That's the whole idea of this. We're happy to have any type of a conversation and look forward to getting a chance to meet all of you. But I'm going to open up. Any questions right now in any of this? We do have a question.
So we have time for 10 minutes for questions. So
this is not a question, but it's more or less a comment. My wife worked for about 3/4 of last year, and we have our money in a mutual fund, and the brilliant mutual fund people forgot to take the RMD last year. So we have 2 RMDs this year, and this, of course, kicked us up into a higher tax bracket. And there is something called a donor-directed fund, in which we can now, if my accountant gets his act together and tells us how much it will be, we can then take all of that in 1 year and then parcel it out over 5 to 7 years. So if anybody has this problem where they are finding that their RMD has kicked them up temporarily into a higher tax bracket, this is one way to get around it.
Yes, and unfortunately, it's a conversation that we run into more frequently than, honestly, I ever like to say, where notices are not going out from those wonderful mutual fund companies or whoever the custodian of the IRA might be. We just sort of left it up to you to make that RMD thing. We told you once, we gave you a 6-month notice, and then we never told you again. It's unfortunate that it happens. But what the gentleman was referring to is the fact that when you do make that donation, you can then have it trigger more years. So you can say, I'd like it to be for the next several years as far as that is concerned. Yes.
The other thing is, we're giving you a quick presentation today, and to your point, you can do those directed contributions. There are so many strategies out there that if we wanted to cover them all, we'd be here all week. So really what it is, it's about understanding some of the concepts and how you can give, but at the same time, it's, you got to have an individual conversation with a financial advisor or somebody, or planner or your tax strategist about what would be the best situation for you given your particular situation. So, but there's so many different ways to do this. We just wanted to get you thinking in that direction.
Questions?
more questions? All right. So if there are no more questions, let's thank Tom and Craig once more. Wonderful. Thank you.